Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. And this is the fourth and final part of a series I've done on valuation. And today's article is going to talk about avoiding the obvious mistakes. Investing is hard enough, everybody. And, it's impossible to get it perfect all the time. But one of the ways that you can kind of move things in your favor a little bit is avoid obvious mistakes. And with valuation, there are mistakes that are subtle and difficult, but there are also periods of valuation where it's just clearly obvious that the market is being, ridiculous or completely misappraising the value of a business. And I'm going to start with a graph on General Electric here. And I've got earnings and price correlated graphs. I'm not going to cover any of the other metrics that I often do in these videos, because what I'm really doing here is looking at valuation when it's obviously irrational. And so if I go back to 1999-2000 on General Electric, and I go to the peak here, which was in August of 2000, you can see that General Electric was trading at a 47 PE ratio at that time. And then in the article, I pointed out that, the price from peak to trough fell over 50%. Actually, it's calculating here at 60.6%. Now, what's really important about this, if I use my scroll bar and calculate the earnings growth rate, earnings grew at about 9.4% at that time. So, this would have warranted a PE ratio of 15, which is what this orange line on the graph is. This is a 15 times each year's earnings plotted on this graph here. And that would be a theoretical fair value or intrinsic value or true worth valuation that I like to talk about all the time. And you can see that we had this reversion to the mean that happened swiftly over the next couple of years here. But having said that, valuation was completely out of whack, and yet people were in love with General Electric at this time. This was a time frame when the company's earnings were actually doing well. This was the Jack Welch era, as I mentioned, and people had gotten really crazy. And of course, many, many stocks were overvalued like General Electric here. And it was a period that ended up resulting in what many investors call, or many people call, the lost decade. And as you can see, General Electric here, since that peak valuation, has never even come close to getting back to that price again, because obviously that was a crazy valuation. There were no fundamentals supporting that. But there are many other valuation lessons that this particular graph, I think, presents for us. Number one is you do see, irrespective of this particular period where the market was just being crazy, you see a pretty high correlation between price and earnings. In other words, where earnings go, price goes. And, you see some very low valuations here. The PE got down to 4.5 here, but that was also during a time of collapsing earnings. And this white line is plotting the dividend, and you can see that General Electric was slashing their dividend, and the market reacted to that. And then in the article, I talked about the fact that, if you were looking at the end of 2017, let me try to hit it just right here, you were looking at a PE ratio that was reasonably attractive. I got it at 16 here. The orange line would have been 15, but you could have also, seen the PE drop a lot further. But the point is the orange line dropped. So even though this looked like a fair valuation, if you will, it resulted in very poor performance, a 34% loss since, the end of 2017 through today, simply because General Electric stock was following its collapsing earnings and collapsing fundamentals, and they virtually eliminated their dividend after that. So there are a lot of lessons in valuation here. The one is it's not just looking at the PE ratio and then, even the dividend yield, because I also, in the article, I talked about the dividend yield averaging a pretty high number during this time frame, and that's what you're looking at right here. You had a 4.8% dividend yield by the end of 2017, and you had a reasonably low valuation, but by the end of 2018, you still had a 4.8% PE. But I want you to notice that the stock now was trading at a very low PE, something like 11 times earnings here, and the moral of the story is that was simply because the earnings, the price, and the dividend all collapsed during that time. So don't just also rely on statistics. But the point of this whole presentation is to talk about making obvious mistakes. And so I'm going to go ahead and look at some different examples here that I covered in the written portion of this article, but I'm also going to take a look at some additional companies as well. So let's start here with Acuity Brands, electrical products. I want you to see a very highly correlated price and earnings up through the Great Recession. The company's only been public since 2001. And then we had this little surge of earnings, and that gets investors all excited sometimes. And we saw the stock price rise up to these astronomically high valuations. We had PEs up here at 35 times earnings, when the company's 12% growth would have represented a PE ratio of around 14 or 15. So we had the stock peaking up here at a price of $275.12 a share up here at the top, at a time when the stock should have been valued at around 125 or so. So this was a clear case of irrational exuberance, and then we saw this significant reversion to the mean / collapse in price and value, where investors lost a great deal of money. But I want to make a point. Investors were loving this stock. This went on for 4 or 5 years here, where the price was way ahead of the company's earnings. And more recently, and I've written articles on this one, we had Albemarle, which is a lithium producer, and we did see a surge in earnings growth here. But once again, we see where the price, where irrational exuberance or investor enthusiasm, greed, if you will, took over, and the price became radically overvalued. And then once again, we've had a reversion to the mean. But we also have the opposite side of the story, which I talked about. Even with weak earnings here, you have periods where valuations are very low. And I'm not going to measure the performance up to here. I'm measuring it from a low valuation here to a rational valuation here, where you would have averaged about 19% a year over that 2 or 3 year period, regardless of the fact that we had all this roller coaster ride in between there. So they're just another example. Now, Cisco is one of the classic examples of markets behaving badly. This was the tech bubble, and I can go back several years here. Cisco was overvalued for a lot of years. But look at the trough or the peak valuation. We had a PE of 161. The stock was at $77 a share. Now, I've still to this day, recently as last week, I read people, I think Brad Thomas, one of my associates at Dividend Kings, did an article on Cisco. And if I recall correctly, there were comments talking about this stock still hasn't recovered. And that's because people see price only. They don't see price in relation to fundamentals. So this was a classic case of a ridiculous valuation by the market. It made no sense. Cisco's stock price fell dramatically from that period over the next 2 years, dropped over 85%, in a couple year period, a 53% annualized loss, but it still never got down to what I would call its earnings justified valuation. And again, there's a lot of lessons in valuation on this particular stock. It rallied back again to a PE of 38. And I want you to notice the orange line is moving very nicely here. The business was doing very well, but once again, you could have owned this stock for several years by paying too much for it. This was an obvious mistake, in other words, that you shouldn't have made, and end up losing, 40%, 38% of your money, or an average annualized loss of 5.2%. Now, in contrast, it works just as well in the opposite. When you find these periods where the stock's valuation got extremely low, here we got a PE under 10, and if you'd have held it to fair value, forget about the overvalued portions, you're making 16% a year. And I might add, this is during a time when earnings growth was slightly less than that. I'm going to not hit it perfectly here, but I'm going to be pretty close. You had earnings growing at about 6.8%, 6.79% per year here. And I want you to notice you're looking at a time here when investing in Cisco would have averaged over 16%. That's, significantly better than the company did, because you got the leverage of buying the stock, or you would have had the leverage of buying the stock when it was significantly undervalued during that time. So, an obvious mistake, by the way, here, and I want to be clear about that, would have been someone who bought Cisco here, watched it go down for the next couple of years, and noticed this lasted. This is the hardest part of this valuation concept here, is that people just don't have the patience to wait that many years. I do, as long as I see this orange line going up, and then once it's paying dividends, which is about when this started happening, as long as I see those dividends are going to grow, I don't care that these prices are dropping, because I would buy this stock with the intent of owning it for many, many years. And you can see, you would have averaged over 9% a year buying Cisco there, even though you would have had losses for the first couple of years of holding the stock. And of course, if you would have bought the stock here and held it, and I got a little low there, so I apologize, but if you'd have held held it to a peak valuation, your rate of return would have been 13%. So valuation has a significant impact on how much money you're going to make. And therefore, when you see crazy levels of valuation, these what I call, obvious mistakes that you should avoid, you should do that. And same with CVS. By the way, you could overpay for a company that grows as consistently as this company has historically. For example, you could have paid a high value here, because this is another lesson in valuation. And if you'd have held it to where it got back to fair value, you would have averaged 9% a year. And there's certainly nothing wrong with making 9% a year. But had you waited till the stock got into fair value and held it to fair value, your rate of return would have been 15% a year. I want you to look at these numbers. You would have turned $10,000, including dividends, into $29,700 by buying it here, where if you bought it up here and held it just for maybe 6 months longer, your $10,000 would have only grown to $13,900. So it's a significant difference in terms of overpaying for a stock and not. But when you see a stock that's highly valued like this, even though this is not as obvious as what we saw here, I want you to still understand that you're taking greater risk to earn a lower rate of return, ceteris paribus. In other words, valuation becoming equal. And same with buying a stock when it's undervalued like this. Now, I would have been in favor of buying CVS here. I'd have been in favor of buying CVS here. And I would argue that those were good buys if had you done it, because right now you'd be, underwater for most of this time. You'd be looking at making a slight profit now, averaging about 7% a year. But once again, if I measure this from buying it here to what I think fair value you should be, you could average 24 or 25% a year. So, the obvious mistake would be to buy it here and sell it. You want to be buying stocks when they're cheap and only selling them if they're radically expensive, if you're going to sell them at all. Now, the next one I'm going to look at here is Molson Coors Brewing Company, some very popular beer brands. And what I want you to notice here about this particular example is you don't really get a lot of growth in this stock. Its average growth has been about 5%, but yet for whatever reasons, this stock got significantly overvalued. The PE got up to 26, and again, that lasted for a couple of years. And then over the next several years, now we've had this massive correction, and people have gone from loving TAP or Molson Coors to now hating Molson Coors. Now, they have had a drop in earnings here, but notice that the stock price fell dramatically, before that. But now they also froze their dividend during this period of time. So, you had a period where there were some, what I would call, to some investors, bad news happening in the stock. And when the price was this high, it was very, very vulnerable to any kind of bad news from that. Now, I want to kind of end this by looking at some very popular stocks here that haven't had the kind of corrections, but maybe are starting to. For example, here you have McDonald's, and I've written about it. Love the company. Would love to buy it at, wished I had have bought it when the valuation was in alignment with its intrinsic value. But now we've had 2 or 3 years. So my point is, when you see a stock that's getting this highly valued, my argument is be aware of that. If a stock has momentum, it might continue to do well for years. In this case, you've seen it for years. You have other names like Microsoft, which I've written about. I love this company, and I want to make that clear. But, the valuation here is becoming really extended, and it's been that way for several years. And if you look at a PE of 30, if you go back here and find Microsoft when it was trading at a PE of 30 in the past, and I'll try to find it here, that's to be about as close as I can get. I want you to understand that ended up in being more than a decade of virtually no rate of return whatsoever. So that's a very high multiple. You're looking at a very low earnings yield on Microsoft right now if you bought it today. Now, if you bought it somewhere back in here, which would have been a great time to buy it, and hadn't sold it yet, I'm not necessarily saying you should sell it. What I'm saying is you should be aware that you're holding a very highly valued stock that's being valued far beyond what its fundamentals would generate. And I don't care how good the company's doing, it's got to translate into the numbers. 3M is another example of a stock that's starting to have a correction. I could go on and on, ladies and gentlemen. The point is that there are obvious mistakes, and when you see valuations completely out of alignment with fundamental value, you should be aware of that, and you should be behaving accordingly. Either have a watchful eye if you own the stock. You might not want to jump off off of momentum, if like a Microsoft example I just showed, if the stock has momentum, and you might not want to sell too early, but at the same time, you don't want to wait too long. And as you would have seen, we had several years of overvaluation in 3M, and in more recent years, that's resulted in about a 35% drop. But it should have been obvious that this peak valuation here was even more severe than anything we saw back in these time frames. So investing is hard. Don't make the obvious mistakes. Look for valuation, and it goes just on the other hand. Don't buy a stock at fair value and then sell it when it's undervalued, because you're normally giving away an asset for less than it's worth. But also don't buy a stock when the fundamentals don't tell you that you're getting a good return on your invested capital. Anyway, this has been Chuck Carnival saying thanks for watching. I appreciate it. Look forward to talking to you again soon.